Welcome to the De-Risk Daily Brief. It's Tuesday, November 4th. Yesterday, we talked about a fragile rally running on liquidity in a data vacuum. Today, that fragility has snapped. The theme is a reality check as a coordinated global growth scare takes hold. U.S. futures are pointing sharply lower across the board, with the Nasdaq down over 1.3%, marking a decisive reversal from the optimism we saw just 24 hours ago. This isn't a technical pullback, it's a fundamental repricing of risk. Overnight, we got concrete signals of a slowdown, from a major Japanese shipper warning on the Chinese economy to fresh data showing German industry is planning significant job cuts. Here in the U.S., the narrative is shifting quickly, focusing on a weakening consumer and the end of the corporate labor hoarding trend we've seen for the past year. It feels like the market has stopped ignoring the warning signs and is now pricing them in with urgency. So, Alex, this risk-off tone feels much more tangible than what we discussed yesterday. How is this global growth scare rippling across asset classes, starting with the overnight session in Asia?
It's a powerful shift, Sarah, and you're right. The fundamentals are now overwhelming the technicals. Let's start in Asia, where that dynamic is playing out perfectly. The Nikkei and Hang Seng are both still technically in Golden Cross uptrends, which we noted yesterday. But that bullish picture is being undermined by hard data. Japanese shipping giant MOL just issued a severe profit warning, explicitly blaming a slowing Chinese economy. That's not a forecast. It's a real-time signal from the heart of global trade, and it casts a long shadow over the entire region. That pessimism carried directly into Europe. Germany's DAX is also technically strong, but the German Economic Institute just reported that a full third of the country's companies plan to cut jobs next year, with industrials being the hardest hit. This confirms the recessionary fears we've been tracking and suggests the engine of Europe is sputtering badly. The UK is a bit of a sideshow with the Bank of England decision looming, but the core European story is one of deepening economic gloom. This all brings us back to the US, where the narrative has pivoted from a soft landing to bracing for impact. The sell-off in futures is the market finally pricing in the squeeze on lower-income consumers and signs of a softening labor market. This puts the Fed in a difficult spot. We're hearing more dovish talk. Governor Miron is even calling for a 50 basis point cut. But the market is realizing these cuts might not be a proactive fine-tuning, but a reactive attempt to cushion a real slowdown. This is creating some classic risk-off moves across assets. In fixed income, Treasury yields are pulling back from their highs as growth fears outweigh inflation concerns. But the most important move is in foreign exchange. The dollar index is rallying firmly above 100, testing its 200-day moving average. This is crucial. Despite the dovish Fed chatter, the dollar is catching a strong safe haven bid as global growth fears intensify. It's winning the flight to safety trade, which is putting serious pressure on commodities. Gold has failed at that key $4,000 level, pushed back by the stronger dollar. And crude oil is slipping towards $60 a barrel. The demand destruction narrative, fueled by the slowdown in China and Germany, is now easily overpowering the OPEC Plus supply management story. And the exclamation point on all this is volatility. The VIX has spiked nearly 12% to trade above 19, a clear signal that complacency is over and fear is back in the driver's seat. So, Sarah, we're seeing a classic coordinated risk-off move. The market is no longer flying blind. It's seeing clear signs of a slowdown and is repricing everything accordingly.
So the dominant theme is a sharp pivot from liquidity-fueled optimism to a tangible fear of a global slowdown, with the U.S. dollar acting as the primary safe haven. With the U.S. government shutdown continuing, today's private and secondary data releases will be even more critical for traders looking for confirmation of the slowdown. The main events to watch in the U.S. session are the JOLTS Job Openings and factory orders data for September. These will give us a much-needed, albeit slightly delayed, read on the health of the labor market and the industrial economy. Any significant weakness there could accelerate today's risk-off move. We'll also be parsing every word from central bankers. In the U.S., we have Fed Governor Bowman speaking, while in Europe, the ECB's Nagel is on the docket. Their tone on this emerging growth scare will be scrutinized intensely. And looking ahead to the Asian session, the Bank of Japan will release its latest meeting minutes, which will be combed for any further clues about its increasingly hawkish policy path. It's a day where the narrative has clearly shifted, and the incoming data will either confirm or challenge it. We'll leave it there. Thanks for listening to the De-Risk Daily Brief. Disclaimer, this podcast is for informational purposes only and does not constitute financial advice. All investment decisions should be made with the help of a professional.